Well, good evening, everyone, and welcome to this inaugural edition of McGill Desautels Talks. Real estate is something that we all encounter, whether it's a place we call home or an investment shaping our future. Tonight, we'll dive deep into this dynamic asset class with two remarkable leaders reshaping its landscape. First, we have Jason Parravano, incoming CEO of Plaza REIT, and then we have Evan Paperman, president of Woodland Capital, whose transition from corporate law to real estate investing offers a unique insight into deals and strategies. So I'd like to start off with an icebreaker. What was your first job growing up, and how did that perspective shape your vision to work?
My first job was working in a funeral home, family business. I'd say, what was the second half? How did it shape?
How did you shape your perspective into finding opportunities and challenges?
I'll tell you what it taught me. Taught me to learn to work. I started, I was 15 years old. I worked there throughout my undergrad, every Sunday, every summer. And it taught me I don't want to be a funeral director.
Interesting. And you, Jason?
I had a lot of firsts. My first job also was working for family, and I figured out very quick I don't want to work for family. Worked at Canadian Tire, worked in restaurants. I had a lot of firsts, and then woke up one day and I said, you know what, I'm going to be an accountant, and did my CA studies and fell into real estate kind of by chance.
Interesting. And as leaders, what's one step of your morning routine or habits you guys have that you guys stick to every morning to start off your day?
I guess every day starts up with a coin toss. So I get up, I go to my daughter's bedroom, I wake her up, and it's a thumbs up if there's no poop in her diaper, and a thumbs down if there is. But that's how I start my day, waking up the baby, having breakfast before heading over to the office or getting on a call.
Interesting.
First thing I do, it's a new thing. I check my recovery on my Whoop. I'm not obsessed with this thing, but I've had it for a few months, and it's a reminder to make good decisions. I'll leave it at that.
Interesting. So I'll dive a bit deeper. Jason, in 2015, you were one of the youngest executives on the Toronto Stock Exchange, leading Plaza REIT from a $20 million market cap to $130 million, which is a remarkable achievement. As you step back into the role as CEO at Plaza REIT, what has changed in the way you lead a team from back then?
So I guess the difference is the business where I'm at now is a lot more bodies. It's 9 million square feet across Eastern Canada. It's $2 billion of assets. It's a labor-intensive business. So the team is much larger, much more spread out from a geographic basis, just over many kilometers. So the big difference between before and now is when you have a small team, you're able to pick the strongest team or make the strongest team. When you have a large team, you're going to have people that are stronger, some people that are stronger and some people that are weaker. So you need to approach some people differently, right? And know everyone's strengths and weaknesses. Not everyone can be a superstar, right? And I don't mean that in a negative way that you have some employees that are no good. It's just some people are clerical and some people are, more analytical, leaders of their division. So you really need to adapt to different types of employees, and that's the biggest difference between a small company and a big one.
Interesting. Evan, you graduated in finance from McGill in 2008, a significant time of uncertainty. You then transitioned into corporate law, and now you're doing real estate investing. Can you tell me about those career moves and what was your thought process?
Graduating with a BCom in finance in 2008 was terrible. I think I graduated and within a few months, Lehman collapsed, Bear Stearns collapsed. All of my friends a year older than me were getting fired in investment banking, and I was like, oh, I'm going to be an investment banker. Well, no, you're not going to do anything close to that. So I knew I wanted to go back to school. I figured background in finance, maybe I won't go into finance, so I won't do an MBA. I toyed with the idea. I figured maybe I'll just go to law school. I think I saw one thing that pushed me was something like 30 of the then 40 whatever US presidents were lawyers. I'm like, okay, if it's good for that, maybe it's good for whatever I want to do. Went to law school with no intention of being a lawyer. Graduated, did recruiting, got recruited by a business law firm in Montreal, a national firm. Had to do a stage to get to become a lawyer, to get my bar. So I did the stage and kind of fell into it. Turned out it was, I thought at the time, more business than law, really. I mean, I was working on mergers and acquisition, mostly private, some real estate, but really I felt the transactions, the deal flow. I love the idea of like working on these deals, seeing people buy businesses, sell businesses, but I didn't love that I was only working on the transactional part and then kind of like, I'm out. Transitioned to real estate. So anyway, while I was there, I knew it wasn't what I wanted to do long term. And then the transition to real estate, an old friend of mine from high school called me. He was looking at buying a building, just asking my opinion. He was looking for a partner. It was a sixplex in St. Henry. It was $670,000. And he wanted a partner not to have to do it all himself. And so I just, I said, I'll be your partner. Found myself finishing my days as a lawyer, which were then, I don't know, 10 p.m., 11 p.m., and looking for deals, trying to find more properties to buy. And I was enjoying that more than my day job. So Max, my partner, he's still my partner today. He just looked at me one night and just said, quit your fucking job, you hate it. Can I say that? And so we bought our first property in May of 2017. I quit my job in July.
Interesting. What year?
2017.
Okay, and how many properties do you have now?
Today, I'd say in ballpark 30-ish.
Nice, cool. So every industry has unique challenges, right? And real estate is no exception. So I'd like to maybe talk about certain deals or how the real estate sector has evolved. Jason, you focus mainly on retail real estate. And recently in the past 5 years or so, there's been a change in behavior consumer, the rise of e-commerce. How did that affect your space? And if you could share a story with how you adapted.
So retail real estate is very, very different than industrial, residential, office, because it's not a commodity product. It's about location. And it's about fundamentals and economic rents. So when it comes to retail real estate, it's all driven by consumer demand. Now, demographics and macro trends, whether it's population growth from net immigration or just general organic population growth, but population getting bigger and an aging population, is great for consumer demand. We can all agree with that. And due to the fact that land is not getting any cheaper, economic rents in retail real estate do not allow individuals or companies to actually build this stuff new at good returns. So there's less of it. So in one way, Amazon or e-commerce has hurt the need or diminish the need for retail brick and mortar space, but at the same time, the increase in consumer demand and population has worked in the opposite direction, so it's increased the need for the space. And because no one else is building it, I always use this example, when we build or when we own a retail plaza or an open air strip, we're not in the mall business. We'll have a 20,000 square foot building on a 100,000 square foot piece of land. So when we're buying this stuff or building this stuff, we're only using 20% of the space, and that's why the economics don't work. And that's why no one's building it anymore, because the economics don't work. So they're building the multi-res or the mixed-use project or the industrial project, which takes up, or utilizes almost all of a piece of land, so they can afford to pay for or a higher price for that piece of land. So there's less of it. The supply is staying the same or diminishing because of other needs in Canada for residential or industrial real estate. So that is good for people like us or companies like us that own the dirt or own the real estate already, because we're able to drive our market rents up because of the fact that it's a game of supply and demand. And supply is pretty flat.
Interesting. And Evan, investing in real estate comes with its unique set of risks. You're focused mainly on residential. And with the high climate of interest rates, how has that affected your business? And what challenges do you see and how do you try to overcome it?
On a small scale, I mean, anecdotally, I have projects that looked real good when we bought them in 2020, 2021, and we got totally crushed by interest. Variable rate mortgages, floating rate mortgages. When a deal, everything looks good, but every line item on your pro forma is important. And as soon as one of them doesn't work out, another one doesn't work out, and before you know it, a deal doesn't work out the way you thought it was going to. And you don't make money on all of them. And so, interest cost unexpectedly that we didn't factor in when we bought certain projects came back to bite us in the ass on a few. Now, on a more of a macro scale, the quick surge in interest rates, I think we were up like 5% in like 18 months to prime in Canada. It was a major shock to the system. Deal flow came to almost a halt for the stuff that we look for. It's picking back up again, especially in the last few months since there's been cuts. Now you've got some sellers looking to sell again because, interest cost is such a huge portion of any transaction, no matter whether you're buying, building, whatever it is. So you can't avoid it.
But it's also been an opportunity, because when interest rates were zero, we all lived it, right? 2019, 2020, up until maybe 2021. When interest rates were zero, everybody was doing real estate, right? Everybody, even if it wasn't their core business, even if it was a pastime, they're doing real estate. Why? Because you could do real estate, make a mistake, and because the spread between your interest rate and the cap rate or your IRR or your going in yield was so big, you can make a mistake and still make out okay, right? So the fact that rates have come up now has weeded out a lot of people from the real estate sector. So the people doing it as a pastime or as a hobby don't do it anymore because the mistakes hurt. So now the people that are left doing it are the ones that do it full time. So it's actually reduced competition a little bit, whereas you're not bidding against or working against people that are less return sensitive.
Interesting. I was wondering if you could dig deeper on that. A lot of us don't have a real estate background, and you mentioned cap rate. How has the cap rate really changed? And maybe if you could give us a quick 101 on cap rates.
So cap rates, there's two ways to look at it. If you're buying something stable, you're buying on a cap rate basis, and it's a going in yield, and over time you want to increase the NOI. So cap rate is a simple calculation. It's NOI, net operating income, divided by the purchase price. But what we saw a lot of in 2020, 2021, especially in the multi-res and the industrial sector, is cap rate didn't make a difference because the in-place rents were so low. They hadn't caught up to market. Our industrial rental rates for 20 years were $6. And today they're mid to high teens. Residential rents, Evan can talk to it, never went over $2,000. Now that's the norm. So cap rates out the window with those types of calculations or those types of investments. When you're buying finished product though, cap rates have gone up a little bit. They've expanded because you need to create that spread between your interest rate and the cap rate in order to make money.
Thank you very much. So as MBA students, we often focus on frameworks and models for us to solve complex problems. In your respective roles, I'm curious to know, what is a counterintuitive lesson that you guys learned that would surprise people outside the industry?
It's not about being smart. Like at the end of the day, this business is all based on your network. It's based on your contacts, right? And you don't need to be smart in real estate to make money. You just have to know some smart people. So if you run into problems, you know who to call.
Interesting. To build on that, it all comes down to your network. At the end of the day, when you're dealing with banks, you're dealing with people. So the guy at the bank making the decision about whether to give you the loan or what interest rate to give you or whether you get approval for this, are you going to get construction financing, are you not, like, these are people. And the better relationship you have with these people, the more likely you're going to be successful.
Interesting. So when it comes to those people, and oftentimes we hear that investing in real estate is long term. Jason, as someone leading a publicly traded company, how do you balance immediate shareholder returns compared to ensuring your long-term vision stays stable?
It's tough. You have to have the right balance because, like you said, in the public realm, you're living quarter to quarter, right? So the impact of your investment, especially in real estate, might not have a direct impact on the next quarter's results, right? So you have to play that game of the right amount of long-term thinking paired with the right amount of short-term thinking. But then you also need the pipeline that's always rolling so that something's always coming online, right? But there's really two ways of investing in real estate. There's the income approach, right? Where that's, my business, the Plaza REIT business, is really about cashing a check every month. And then there's the...
Not my business at all.
That's it. So that's what I was going to say. Evan's business, he doesn't care about making money every month, right? He's about creating or leveraging his equity to be able to take out money. Maybe you talk a little bit about that.
Yeah, and it's interesting because I have this conversation. We do a mix. We do some projects on our own with our own equity, our own capital. We take partners in other projects depending on scale, timing, whatever it is. And we've spoken to a lot of investors, and a lot of them ask about yield. What's the yield? And I look at them, I'm like, yield? Like, we don't do yield. We buy, we add value, and then we either sell or refinance and borrow against that added equity that we've created. So for me, if I'm seeing a cash flow or a yield on a monthly or annual basis, I see that as borrowing power. And so I take that money and I'm like, okay, if it's generating X $1,000 a month of free cash flow, well, what can I borrow against that cash flow and take that equity out and then either buy something else, pay off another loan, move that money around, but it's a completely different model at Jason's. And in large part because I'm not accountable to anybody else. Yes, I'm accountable to investors, but the people that invest with me understand that it's not a cash flow game at all.
So it's also interesting because you're more in the private industry, right? So your investors don't expect a quarter-to-quarter return. You also mentioned prior to that relationships with banks and individuals. You talked to me off camera about an incident that happened with one of your projects, and I was wondering if you could share it to the audience.
Which one was it?
Was it regarding the project that the bank pulled out last second? And more often than not, as MBA students, we're told that banks are solid institutions that are reliable. Yeah. So I'm curious if you could share that.
It was a building we bought. The acquisition of that building is a lot more interesting than this part, but we bought it and we got an offer to sell it within a few months later. We had gone through a whole zoning change before buying it. That was our value add. We had an offer to sell it, and it was to an unsophisticated buyer, so we were really helping push the financing along through our contacts. The bank went as far as publishing a mortgage against the property. Typically, you'll publish a mortgage and the bank will fund it within a few days. That's really the last step. And they published the mortgage, and then there were just delays. They had more questions. They wanted cost consultants on the potential renovation project. They just kept pushing, and then they backed out. And we were now in a situation where we have a buyer who wants to buy the property for, in my view at the time, much more than it was worth. So we weren't going to go back to market and try to sell it to somebody else. But now we're trying to approach other banks, and those banks can see that there was a mortgage published against our building. So their first reaction is, well, why did they publish and back out? So it kind of burned our relationship, or our property's relationship, with potential lenders, because it looked like something went wrong when really nothing went wrong. And we learned after the fact that this specific bank was having some financial difficulties on their debt side. I don't know what's true, what's not true, but anyway, we ended up not finding, or we actually ended up finding another lender, and then we backed out and we kept the building.
Interesting. So, it's a beautiful segue to deal making and the art of deal making. When we talked about real estate, more often than not, the core is usually where strategy meets creativity and risk meets reward. So, given your legal background, it gives you a unique perspective structuring deals. Can you share an example of when your legal background helped you find an advantage in a deal?
I'd say my legal background, I don't want to say I take advantage of situations, but a lot of the properties that we buy are from less sophisticated vendors, people that have owned properties for a long time. And so, sometimes because I do all of the contracts in-house, all of our offers and whatnot, I just draft them to my advantage. A lot of vendors don't really read the details of what they're signing, or the fact that I gave myself the ability to seek a zoning change, and that so long as I continue to make progress, whatever that means, I have this offer locked onto the property indefinitely. That worked in our favor on a couple of deals that we were able to sort of extend. We had a stranglehold on the property, and it gave us enough time to get that zoning change, get the financing that we wanted, and the vendor couldn't really walk away.
Talking about zoning changes that you mentioned, Jason, your business is mainly focused on zoning changes before you buy a property or for development. Can you speak on that?
Yeah, it sucks. It's a horrible process. Time kills all deals. I was actually having this conversation with my company at large a couple of weeks ago, and how we're shifting our strategy a little bit going forward to no longer do. Has everyone heard the term greenfield development? Greenfield development basically means buying a piece of land and building on it. The numbers don't lie, okay? So I had our CFO do this analysis that basically showed the comparison of buying a piece of land and building on it and collecting revenues on it within 2 years, 3 years, 4 years, and 5 years. And comparing that investment to buying finished product or stuff that's already entitled, or a building that exists where you don't need to go through the zoning change or official plan amendments in Ontario, et cetera, et cetera, et cetera. And what we actually figured out doing very simple math and taking into consideration the opportunity cost of not having the revenue. So when I say the opportunity cost, meaning comparing buying the land, sitting on it while you do the zoning change until you collect the revenue, to buying the building, and the opportunity cost of not buying the building is not making the rent, right? So we did this exercise, and believe it or not, if we buy something at a going-in yield of 6.5% versus building something at a 7.5% yield on cost, we need to be able to do it in less than 3 years to make money, or to make more money over a period of 10. So it just goes to show how much time hurts the deal, right? And in this day and age, coupled with the fact that costs of construction have more than doubled in Canada because of all the underlying costs and labor, et cetera, et cetera, et cetera, and supply chain issues coming out of COVID. So that, with cost, basically makes building and going through zoning changes very, very difficult in retail. It still works in residential because you're going up, right? You're adding density, but in retail it's tough. So yeah, back to my comment, it sucks.
Yeah, it definitely does sound like it sucks. Well, a lot of real estate is about uncovering hidden value. And I feel like now it's a challenge, as many of us would want to maybe buy a property in the future, more residential. We are scared due to the interest rate. How have you guys uncovered hidden value in retail real estate or in residential?
We've had to get creative. Obviously, we already talked about how interest rates really just damage the bottom line on a lot of projects. The residential market for buying existing product is extremely competitive now. There's a lot of institutional money that's gone into residential investment in the last say 10 years or less, it's become much more of an investment product than just housing, which it was for a long time. So we've looked elsewhere. I mean, we've looked at some office to residential conversions. It's extremely hard to make them make sense. I mean, imagine if you had to convert this to apartments, your windows don't open. Where are you going to put your bathrooms? What does the floor plate look like? So we haven't been able to find some of those that make sense. We have done some other conversions from former seniors' residences. So, in COVID, unfortunately, a lot, especially in Quebec, there was a lot of deaths in these seniors' residences. As a result, the Quebec government imposed tons of additional regulations. So, if you wash the sheets once a week, now you got to do it twice a week. If you had, one staff for every 10, you need to have 2 staff for every 10. So costs skyrocketed and tons of these places closed. So you've got these vacant buildings, small units, typically some of them in really good areas. So we bought a few of those and converted them to small affordable housing. There's a huge shortage of affordable housing in Montreal, and student housing. We're looking at small studios of 300 square feet, fine for a student who wants a place in a good location, and we're also buying, in that case, a vacant building. Don't have to deal with existing tenants who pay, legacy rents of, paying $500 for a 2-bedroom. They're never going to leave. You're never going to make money on that. So, that's one direction we've decided to pivot. Just an example of being creative to make things work.
Interesting. And you, Jason, how do you uncover value?
So I work, the REIT world is a different structure. So we've done many, many different creative style deals when cap rates got really compressed. Meaning we did tax deals, right? You own a piece of property for 20 years, you're going to depreciate it, right? So your UCC balance through CCAA is going to go down to almost nothing. So when you sell it, you unlock a lot of recapture for vendors, right? There's capital gains. So I remember a great deal I did in 2021, 2022, something around there, where the market was on fire because interest rates were 0. And like I said, everyone was doing real estate, right? That was the, la mode, if you want to call it. And I proposed a structure to a vendor which rolled an asset into an LP at the existing cost base. And then I bought the shares of the LP so that the vendor didn't have to pay any recapture. And I ended up saving saving the vendor a $3 million tax bill and shaving $2 million off my purchase price because I didn't care about the tax impact because a REIT doesn't pay tax, right? I didn't care about the UCC balance. You have to be careful. There's a balancing act kind of thing, but it was a creative way to be not the highest bidder, but the vendor ends up with the same proceeds in their pocket. So we did that on a $25 million transaction, which is $2 million on $25 million is pretty big in terms of savings, and allowed us to hit better than average returns in that market given the compression in cap rates. So that's one example where you take advantage of your structure, you take advantage of what you do and what you know well. And like I said, I have an accounting or somewhat accounting background that allows me to think that way, and that's a competitive advantage when your competition is very, very finance focused and looking at the pre-tax numbers or the not taking into consideration these more complex or complicated structures that could help a vendor out for a purchaser that doesn't care.
That's quite interesting. It's like you thought outside of the box just to get that deal done. So moving on, we talk a lot at McGill about sustainability and the notion of sustainability, and it's been a main pillar in real estate. I think about Royal Mount. They now have beehives on the roofs of the mall to basically attract more of an audience that are favorable to eco-conscious development. How do you guys think about eco-conscious development, and how has that impacted both of your recent developments?
For us, so CMHC, Canada Mortgage Housing Corporation, they provide government insured mortgages, or they'll insure mortgages from a bank for residential acquisitions, refinancing, and whatnot. Typically, they'll give you a longer amortization. They'll give you a lower interest rate. They'll give you a higher loan to value. So much better than going, say, to a conventional bank. They're actually a huge reason why a lot of people didn't go bankrupt when interest rates skyrocketed. So CMHC put in place a program a few years ago called MLI Select, where if you meet certain criteria for either energy efficiency, affordability, or accessibility, they'll give you even more favorable financing terms. So for me, it's, I don't want to say profit driven, but it's bottom line driven. And I'm looking at a project and I'm saying, okay, if I make this building more energy efficient, I get better financing terms. So, and there's a whole process, there's experts, there's reports, there's things you have to do. So I look at a project and I'm saying, okay, I have to spend $3,000 per unit to put in heat pumps. As a result, it'll decrease the overall energy consumption of the building by 40%. I get 100 points according to MLI Select, and now I can get 95% loan to value on a refi. I can get a 50-year amortization, and I can get interest rates that are a 50 basis point spread over the commercial bond yields, which means today I would refinance at, say, 3.5%. So, extremely favorable terms. It's the government. The government is pushing these initiatives, encouraging owners and developers to go that route. And so that's what we've done I think we've done that now on like 4 or 5 projects. I converted a whole building with 100 units, the whole thing from gas to electric. I'm not done yet. It's a complete nightmare logistically. Imagine you're a tenant living in an apartment and I knock on your door and I have to replace your stove, cut out all your heaters, put in electric ones, all while you're living there. And it's December, so I'm not going to make a lot of friends over the next month, but yeah.
Interesting.
Yeah, in the public market world, it's not just about sustainability. It's ESG as a whole. And I would say in retail, so there's 3 components to ESG, right? Environmental, sustainability, and governance. The environmental component in retail is very tough because as retail landlords, we are doing what our tenants want, right? So Dollarama knocks on the door and says, I need 10,000 square feet, and this is how you have to build it. This is what you have to give me. I need a Lennox HVAC machine. I need these kind of lights. But if I want to go further, right? If I want solar panels or a green roof, those things cost money, right? And if you're in the business of making money, you have to ask yourself, who's going to pay? So it's oftentimes outside of our control what we can do in retail from an environmental standpoint, right? We can ensure we have clean sites, no contamination, all that. But when it comes to making our properties better, it's or making them more energy efficient, it's really what the tenants want us to do. Sustainability, not as relevant, I guess, in our rents, right? That's a different world. There are sustainability elements in our business, and then governance comes down to gender equality, equal pay, having the right mix of different types of people within the business on the board and all that. So we have to hit on a little bit of everything. And we publish a report every year that talks about it. And when it comes to sustainability, we encourage our employees to spend time giving back. That's a big part of it. So all those 3 elements together make up the ESG for our business, which is tracked and will continue to be more and more relevant and more investigated or focused on going forward.
Very interesting. And, technology has been incredibly advancing in the recent years. We hear a lot of talks about AI, and I feel like innovation does also challenge traditional industries like real estate. So how has technology, maybe operational or strategy-wise, affected your businesses?
I think real estate is the last one to implement some of the technology stuff, and I'm not talking about the back office of real estate, but I mean like real hands-on real estate. I find we're a little bit behind the curve. There is tons of technology that goes into building operations, right? We see it between smart lights, smart heaters, all the prop tech stuff that goes into it. But when it comes to actually running the business in terms of back office, AI can and probably will replace a lot of clerical roles, right? The hydro invoice comes in. Well, before you'd have someone open the envelope, scan it, input the data for the journal entry. Someone also input the data in Treasury to make an EFT, and then a check might go out or a wire goes out. Well, with AI, actually, that thing just needs to be scanned. A journal entry is created, a payment is created, it goes into your accounting, and you're done, right? So creating those kind of AI workflows is more and more present, or more and more a part of everyday life now. People are talking about it. But I think as from a back office standpoint, we're behind as an industry. That's my experience.
Yeah, I mean, from where I see it most is on the acquisition side. I mean, for one, information is so readily available today. I mean, you've got CoStar, you've got JLR, you've got all these websites where information is at your fingertips, right? Even in Quebec, I mean, we've got land registry that's public. We've got an enterprise register that's public. So any building in Quebec, you give me the address, I could tell you who owns it to the person, right? Not just the company, but I'll tell you who the directors are. I'll tell you where they live. I mean, there's a lot of information that's available that wasn't available to the previous generation.
You can tell them what they paid and if they have a mortgage too.
Yeah, and people track that, right? People look and see, okay, get a list of every mortgage that was radiated over the last, every day, or what mortgages were published. I mean, I buy a building and I get an email from someone who I haven't spoken to in a while saying congrats, because everything's public. So
I would buy a building, I would get an email from someone before I bought it.
Yeah,
because the mortgage gets published first, and that's real.
Yeah, congratulations, how'd you get the financing? MLI Select, which I talked about before. So all the information is there. That makes the acquisition process, I'd say, like democratized. Everyone has access to this. So what we've tried to do, and we're working on now, don't know if it's going to work, but we're working with 2 developers that are building an AI model to analyze deals. So it'll take publicly available information, or a property is listed for sale, and it'll gather all the information that they put out there, filter it through our model, and then spit out a proposed purchase price or an offer price. It's not ever going to be 100%, right? Because there's too many factors that'll go into it. But if it can get us 80% of the way there, then we can evaluate so many more deals, and it's a numbers game. We make hundreds of offers every year. We review hundreds of potential acquisitions every month. Like, we're constantly churning. We have an acquisitions team that all they do is look for properties to buy. It's tough to find good deals out there. You have to do whatever you can, and so if we can find some kind of automated system that's going to give us just the smallest leg up on our competitor, that's what we're looking to find.
That's great. So as we slowly wrap up and open up to Q&A, I'd like to take a step back and reflect on your personal moments, your journeys. We talked a lot about your achievements. I was wondering if you guys could share maybe a failure or a setback that ultimately became a turning point in your careers.
Way to put us on the spot.
My pleasure.
You know what, like, you make mistakes every day, right? I wouldn't say there's a monumental failure in my life that I'm still regretting, but you make mistakes, and to be honest with you, as long as you don't do them twice, it's okay, right? And you want to also encourage people to take risks, and oftentimes risks results in mistakes, So again, there's the balancing act here between the right risk to take and the wrong risk to take. But what I just tell people all the time is don't do the same one twice, or try not to, right? But that's what it comes down to. For me, that's what it is.
I honestly can't think of a specific failure that I learned something from. Like I said, you're not going to make money on every deal. Thankfully, the winners outweigh the losers. But I can remember the deals that I had that didn't go as planned, and I know exactly why. At the time, not something I thought of, and now looking back, I can't believe I didn't think of bringing a structural engineer to check out the foundation before I bought a building. You can be damn sure that every time I buy a building, there's a structural engineer that comes and visits that building now.
Very interesting. I'd like to end on this final question. There's two sides to it. I'd like to know what's the best advice you've ever been given, and what's the nicest thing that someone ever did for you guys?
Two. So one, you can never go wrong doing the right thing. And then the other one was something that always stuck out to me. When I was in my first day of law school, we were all sitting in the moot court, and the dean was going around and like pointing people out and saying, "Tell me about yourself." And the next guy, "Tell me about yourself." And this one was an Olympic athlete, and this one was an Oxford grad, and like really smart people, and intimidating. And I'm like, and then there's me, who like I went from McGill to McGill, from Montreal to McGill to McGill. I'm still here because it's in my backyard. Like I don't have a story like that. And the dean said, if you doubt why you're here and you don't have confidence in yourself, have confidence in us, because we wouldn't put you in this room if we didn't think you were capable of succeeding. And I find a lot of times I have this like imposter syndrome, like I'm making offer. Today I made an offer on a $95 million portfolio. Like I think like, who am I to make a $95 million offer? Like, and then,
You don't have the money.
I definitely don't have the money. That's contacts, right?
That's it.
So then I think like
I've known him a long time.
Yes, when I really didn't have any money. But think about like I'm here for a reason. I got to the point I'm at because I worked hard, and have a little confidence in yourself. Trust yourself, and everybody has imposter syndrome every now and then. Just fake it till you make it.
I'll say like I've gotten good advice from a lot of people over the last 20 years, and it's always it's different advice at different times in your life. So you oftentimes I don't remember the advice I got 20 years ago or 15 years ago or 10 years ago. I just know that it was good because good things came from it. But going back from the most recent good advice I got, when I joined Plaza REIT about a year ago, one of my board members who has been around real estate and corporate Canada for a very, very long time, a very, very well-respected figure in the industry. And at this time I wasn't named to be CEO yet of Plaza. It was when I joined the business, I joined as COO. And there was talks about taking on that role. But he told me something, and it's probably the best advice I've gotten in the last year. And it's the best advice I've gotten because I constantly refer back to it and I have to remind myself of it. He said to me, what makes a good CEO is not getting involved in the deals, right? Because in this world, Mr. Imposter syndrome over here, we're deal junkies, right? That's a drug for us, right? It's our crack. Like we're putting out the offer, finding the deal, closing the deal, doing the financing, signing the lease, getting the refi, writing the check. That's all deal junkie syndrome stuff. So he said to me, to be a good CEO, you need to be outside of the deal. Don't get involved in the deal. And at first I'm like, well, got to get involved in the deal. They need my help, right? How can they do it without me? And the reality is, what he said was, if you can't stay out of the deal, there's two reasons. One, you don't have the discipline to stay out of it. Or two, you don't have the right team because you don't trust them to do it. So I constantly refer back to that advice. I've constantly referred back to that advice in the last year because it's in our nature to get involved with the deal. But you have to step away. And by stepping outside of the deal, it actually allows you to provide good advice because you're indifferent, right? The people that are in the deals are coming to you with questions. They're looking for you. They're saying, Jason, Evan, like this price, that price? Do we waive conditions? Do we go with this tenant or that tenant, right? If you are involved in the deal, you cannot be indifferent. You cannot have an indifferent opinion, right? So that I found that was great advice, and also over a course of your career, you're going to have many mentors, but you're also going to have many coaches, and there is a difference, and I won't tell you why there's a difference because you'll figure it out as you go on, but it is an important difference, right? And I'd say some great advice I've gotten over the last year actually came from one of my coaches because they're in it for you, right? In a relationship with a mentor, it's a back and forth style relationship. Talk about me, talk about you, shoot the shit. When you're talking to a coach, it's only about you, right? And they try to help you figure out without telling you what to do, what the right thing to do is. So that being said, I think great advice to all of you is have mentors, have a coach.
That's great advice. With that, I say thank you guys very much for joining us, and we'll open up to Q&A for this amazing audience. Thank you guys so much.